All right, hello everyone. Thanks for tuning in. You can see the bear hair, oh, it kind of rhymes. The bear hair is roaring and growling, and he wants to talk about how we can make money when the market is going down. Now, I think it's easier to make money when the market is going down. And you might be thinking, like, dude, you're crazy. But here's the thing, markets go up on hope. All right, people buy because they hope something's going to happen. People sell and markets go down because of fear. People sell because they're afraid they're going to lose money. Fear is a more powerful emotion than hope, so markets tend to go down faster than they go up. Now, no one wants a long term sustained bear market because in the long run, it's really not good for pretty much most people. But in the short term, talking like over the next week, next month, maybe a couple months, depending on what your time frame is, there are ways to make money if the market goes down. And you don't need to be that sophisticated. You don't need to be an options trader. You don't need to be a futures trader. What kind of gets me is this whole mantra of go to cash. Even people that are experts or so-called experts, if you put on CNBC or Fox Business News or whatever, when the market started to fall apart in early 2022 last year, this whole mantra is like go to cash, go to cash, go to cash. Well, guess what? There are ETFs that go up if the market goes down, and it's just as easy as buying a stock. Here we have SPY, right? The S&P 500 trust that is very heavily traded. This thing follows the S&P 500. It's the most important benchmark on Wall Street. It's got 500 stocks in it, the 500 biggest stocks, and this is what most people follow. There are other inverse ETFs, but I'm just going to go over the basic SPY ones that I know of. And I'm not endorsing them. There might be rivals that are just as good, but for our intents and purposes, this is more than enough. Now, if you think the market's going to go down, here is something you can buy. It is an ETF that will go up. It trades inversely to the S&P 500. If the S&P 500 goes down by 5%, this will go up by 5%. If the S&P 500 goes down by 10%, this will go up by about 10%. So this is a way that a regular retail investor can just go buy an ETF that's going to go up if they think the market's going to go down. It's also good for hedging. In other words, maybe you have a portfolio, you've made a bunch of money, but you don't want to sell because you don't want to take your gains or there's tax consequences. Well, you can hedge this. You can throw one of these inverse ETFs into your account and the market might go down. This will go up and it'll offset your losses, or in a perfect world, it'll perfectly offset your losses. I mean, hedges never work out perfectly. But anyway, the Pro Share Short S&P 500, and I'm not advertising them. I have no affiliation with them. It's just a very common ETF. It's very popular. It trades millions of shares a day. So symbol SH. You think the market's going down? SH will go up by about as much. Now, if you're really bearish, you can look at this. This is SDS. This is the ProShares Ultra Short S&P 500 ETF. And again, whatever. I'm not endorsing them. I just know it's a popular thing. This uses leverage. This is designed to go up by twice as much as the S&P goes down. So if the S&P goes down by 2%, this will go up by 4%. If the S&P goes down by 5%, this will go up by 10%. You can do the math. Of course, you got to be careful because if it goes against you, you think the S&P is going to go down and actually goes up, and you have a position in this, well, you're going to lose money twice as fast. So, it's a double-edged sword. But this is just a quick little FYI lesson here. So you can know if you're a retail trader and you don't can't take the time to think about futures or options, there are other alternatives. Also, if you are an options trader, I think that if you look at some of these inverse ETFs, you're going to get cheaper premiums. In other words, the vast majority of investors think, all right, if the vast majority of investors think the S&P is going to go down, they're going to buy puts, and because it's such a popular trade, they're going to have to pay probably a pretty high premium. If you buy calls on the inverse ETF, you're taking the same strategy. You're setting yourself up for the market to go lower, but the position probably costs a little bit less to get into. Now, if you're super bearish, this ETF by Direxon. This is Direxon. And these guys got a lot of different ETFs for all kinds of things. I mean, tonight I'm just going to talk about this, but commodities, currency, I don't know about currencies, but commodities, bonds, so forth and so on. Now, if you're really bearish, this ETF is something to get into because if the market goes down by 1%, this will go up by 3%. It's the 3x ETF. It uses leverage. Behind the scenes, there's a lot of really complicated stuff going on with derivatives and options, but you don't need to worry about that. For a regular retail investor, it's just like buying a regular stock. You just buy it, hopefully it goes your way, and you sell it for more money than you bought it for. But again, you got to be careful because if you're wrong, you will lose money by 3x as much. So leverage is a great thing when the market goes your way, but it's a bad thing, obviously, when the market goes against you. But I just wanted to put it out there, let you know this is an FYI session. If you have any questions, feel free to reach out to me, and I will talk to you soon. Thank you, everybody. Thanks for being here.